Good afternoon, everybody. Welcome back. Thanks for joining us for this afternoon session of the Global Debt Business Summit. This next panel I'm really quite excited about because it almost personifies the overall theme of the event itself. It is a very global panel and we'll be taking a macro look at the debt investing sector of the market and from many different angles. So it's my pleasure to hand over to Richard from Deloitte. Richard will be moderating the panel, and we're all looking forward to a great discussion. Thanks, Richard.
Thank you very much, Martin. Well, good afternoon or good morning, as the case may be. And I say that because not only are we joined today by colleagues in Europe, but we have colleagues in the United States as well. So welcoming to them. And of course, you may be watching this on catch up as well. So as I said, good morning or good afternoon. Welcome to the DDC panel discussion on the NPL market. For the next hour or so, we're going to consider how NPLs are expected to trade in the coming years, exploring what has and what will be done to help economies prepare for the after effects of the pandemic on debt investment challenges and opportunities. My name is Richard Bevan. I'm a director within the Portfolio Lead Advisory Services team at Deloitte. Us as a team focus primarily around non-core and non-performing loan transactions, including platform carve-outs, working with banks and private equity funds, as well as end-to-end advisory services. And while our recent focus has been primarily in Europe, we also have people based in Asia and South America providing global coverage to our clients. And this core senior team has advised governments, financial institutions, regulatory authorities, and global investors on deleveraging and loan portfolio transactions across every major asset class, covering over 560 billion of assets. So let me quickly introduce the panelists before going into the discussion. I'm delighted to be joined today by, first of all, Jim Wilson, sorry, apologies there, Jim. Jim joined Karl Marx Management Company in 2001 after 20 years in investment banking and private equity. He has a BA in economics from Dartmouth College and an MBA with high distinction from Harvard Business School. Karl Marx Management Company manages investment funds focused on distressed debt and special credit situations, primarily in the US, and is most active in mid-market leveraged loans and high-yield bonds. During his career, Jim has served on numerous ad hoc credit committees, as well as public, private, and non-profit boards of directors. Welcome, Jim. Secondly, let me introduce Alina Zechiu. Alina is the senior partner at CITR Cyprus Limited, which focuses on distress and crisis management, corporate turnaround, and insolvency. She's a licensed insolvency practitioner, a member of Install Europe. Before joining CITR, Alina worked for BDO Romania for more than a decade as the director of the business restructuring division, specializing in turnaround, restructuring, and bankruptcy proceedings. Prior to that, she previously held the position of large corporate and insolvency director in APS Debt Servicing Cyprus Limited, acquiring a thorough understanding of the Cypriot market and its specific recovery tools. Welcome, Alina.
Thank you, Richard.
Jonathan Nighswander has 25 years experience in private equity and corporate and lender advisory services in both the United States and Europe. Through Schottentor Capital, he specializes in recovering value from distressed assets, NPL portfolios and single name, and real estate in distressed and turnaround situations in the CEE region, being principally Austria, Slovenia, Croatia, Czech Republic, Poland, Romania, and Hungary. In the past, he's provided advisory services to the World Bank and on USAID projects across the CEE, and speaks fluent German, Polish, Russian, and Italian. So welcome, Jonathan. Next, I'd like to introduce Karel Smerak. Karel is Group Director, Transactions and Capital Markets for EOS Holding, Headquartered in Hamburg with almost 7,000 employees across platforms located in 25 countries throughout Europe and North America, and over 2.5 billion euros of assets. EOS Holding is one of Europe's leading distressed debt investors and services, active in a broad range of market segments, from consumer unsecured claims to secured retail and corporate receivables, as well as distressed real estate. Prior to joining EOS, Karel held a variety of roles in some of the world's largest corporations and financial institutions, including Citigroup, General Electric, Unibail Rodamco in Frankfurt, Paris, Prague, and Vienna. His geographical focus has always been primarily the CEE/SEE and Germany. So welcome, Karel. And finally, Fotis Kourmousis is the Special Secretary for Private Debt Management, a member of the Board of the Directors and Chairman of the Audit Committee of the Hellenic Development Bank, promoting investment financing in cooperation with EIB. He's also Vice President of the High Council at Equifund, promoting venture capital finance in cooperation with EIF, and a member of the Council of the Liquidity Observatory of Greece, which monitors new financing to the economy. As Special Secretary, is responsible for formulating and implementing the legal framework for private debt management, focusing on non-performing loans, as well as debts towards the state. His flagship projects include law drafting, as well as creation of debt restructuring and subsidy schemes with automated procedures through IT platforms designed to improve the operation of insolvency law in Greece, collateral enforcement, and a number of COVID support schemes. And Fotis will today be speaking in his capacity as Special Secretary. And I'm hoping Fotis will be able to join us. He was, I know, finishing off a call prior to this. So I'm hoping he's going to be able to join us as soon as possible. So welcome to the panel. Welcome to you all. And let's kick off this session. So first of all, global GDP shrank by 3.3% in 2020, but is forecast to rebound strongly in 2021, with 6% growth in 2021 and 4.4% in 2022. Nevertheless, there are significant variances and much uncertainty around the forecasts. Advanced economies saw sharper falls of 4.7% in 2020 and will see marginally slow recoveries compared to emerging markets and developing economies. However, perhaps driven by unprecedented levels of fiscal stimulus, and inflationary pressures are starting to build. So what are the big questions in the panelists' mind, and how is this impacting on their investment decisions? And perhaps I'll start now with Jim. What's your view on this?
Thanks, Richard. Well, I'll obviously give a perspective from the US, and on growth is strong here. There's no doubt about it. Most estimates for second quarter GDP are up anywhere 8 to 10%. The Federal Reserve is predicting 7% growth for the year 2021, and they bumped. That's an increase of the forecast they had made just this past March, where they thought it was 6.5%. And I think the economy actually would be growing even faster if it weren't for shortages of materials as well as labor that a lot of businesses are dealing with and are struggling to meet demand. So the big debate here is really about inflation, and for those of us in financial markets, that's really all about interest rates and when the Federal Reserve will move on both short-term rates as well as its quantitative easing program. And there's no doubt prices are rising. The the Fed itself is predicting, based on its measure of PCE, it's predicting 3.4% inflation this year, and that's up almost 100 basis points from what they were projecting in their March forecast. So it's running hot. It's running hotter than they thought. If you listen to many first quarter earnings forecasts here, virtually all the businesses reported cost pressures and that they were dealing with by increasing prices. So, that sounds like a spiral to me. Many people dismiss it as both transitory or base effects, but the month-to-month price increases remain quite strong here. So it's a big question, and with all the leverage that's built up both on behalf of the U.S. Treasury, but also in corporate markets, there's a high sensitivity to interest rates. Duration is long, leverage is high, ratings are low, and you can see that just in some of the volatility that we've seen in the last week when the Federal Reserve indicated that they might move a little bit sooner, or there was a little diversity of opinion on the course of interest rates, and the market sold off just on the whiff of that. And so it's definitely something that is worth watching, and will definitely affect our markets, because the companies, they've been getting away with high degrees of leverage because coverage is strong, and coverage is strong because rates are low. And when rates go up to more, those of us who, were around in the 70s and 80s have a different perspective. And if rates get up to historical averages, it will cause a lot of pain.
Okay, thank you. And so, John, what's your perspective? How's this impacting upon your thought processes for investment decisions?
I've been thinking about that because if you have an inflationary environment, then actually, historically, NPLs turn out to be negatively correlated with NPLs. Actually went around and did a little research just for fun. And there's actually some literature on the subject, including Cyprus, for example, where they've done studies that show that there's negative correlation. The more inflation, the fewer NPLs, which is not surprising, right? Because essentially that's inflating away the loan. The value of the loan is actually decreasing in real dollars as it inflates. So it's great for borrowers if you have inflation. For people who buy NPLs, maybe a mixed bag, because on the one hand, the people who are holding the loans are likely to get a better recovery because they're going to have more cash in their pockets and they can pay. The question is, what's that cash going to be worth once you finally get it? So you've got that trade-off you've got to measure, which makes makes it a little more interesting than the current environment. Try to figure those parameters out. On the other hand, though, I was also worried about inflation, and the more I'm becoming less concerned or less convinced that it's an issue just in the last week, really, as I look around. I notice the commodity prices have slowed or started dropping in like the last month. Copper dropped, natural gas has stayed flat, lumber prices have started falling around the world as well. So it could be that there is some truth to that notion that we're dealing with transitory inflation. I think like Paul Krugman used the metaphor, you got a car stuck in the mud and you start it up and you spin it, you're gonna get a lot of mud flying, but then eventually will even out. So we could be looking at that. And just totally anecdotally, I was walking down the main shopping street in Vienna today, and I noticed that every retailer has massive sales going on right now, minus 20% off, 50% off, 75% off, which implies that a lot of retailers have way too much stock. So I think there's probably a lot of inventory that built up over the lockdown. People couldn't sell. There's another question to sell that, and that might sort of counterbalance all the cash that consumers have in their pockets. Again, that's sort of an anecdotal observation. I didn't take the time.
Okay, well, we're gonna get to some of the topics later on in terms of sectors. Karel, do you have a view? What are you seeing in the markets that you're specifically interested in?
I actually resonate with a lot, that has been said so far. I see there's sort of different dimensions, step one, I agree that inflation is a consideration which is very present, and people are trying to figure out what is happening and what does it mean. And there's different dimensions to that. One, I think there's a difference between what I would call high margin markets, places like Bulgaria, Serbia, some segments in Central Eastern Europe, where the margins or the expected returns are so high that the refinancing, the cost of refinancing isn't that relevant. And these also tend to be markets where bidders are not highly levered. We're not really talking sophisticated, highly levered securitization structures, but it's sort of plain vanilla buying with double-digit IRR of NPLs. So I think that's like one, market segment which is not immediately impacted as much as some of the more competitive and more highly levered markets would be, such as Italy or possibly Greece or Spain. So I think this distinction between markets based on how competitive and how highly levered they are is quite important. Another dimension, we are also still trying to figure it out, but I think there will be a difference between secured assets, which have real estate as the underlying collateral, and unsecured assets, which rely on people paying sort of from their income, and they will probably be affected differently. And the third sort of dimension of the whole thing is depending on how individual investors have set up their financings and for how long have they locked in sort of their bonds or wherever they get their debt finance from, if they need debt finance. That will, I think, also sort of push some of the players, some of the investors out of the market.
I mean, I think this very much goes to sort of perhaps to the next question, which is around sort of estimates for NPL volumes. So I think it was last year in August 2020, the ECB estimated that in the severe but plausible scenario, European NPLs could reach 1.4 trillion euros. And looking at the Asia Pacific region, Fitch were forecasting that levels there could double in the next few years, albeit that obviously the timing around any sort of anticipated uptick is dependent on a number of factors, including the sort of shape of the economic recovery and how quickly sort of fiscal stimulus and forbearance measures are unwound. So sort of continuing with that theme that you were discussing there, Karel, considering your sort of areas of interest, where you've been most active, what do you see as these sort of emerging trends in terms of distressed debt, trading, investing, and for NPLs?
Yeah, I think within the Central Eastern European region, by far the largest NPL market is Greece. And I think we are seeing, that it's quite an active jurisdiction. So far, the focus has been on large transactions, the 100 million plus type of purchase price transactions, very often in the shape of securitizations. What we are seeing in Greece is the emergence of smaller deals, not many, but there are single-digit euro investment transactions or low double-digit, both in the NPL space and the REO space. So that's one. Second, sort of emergent trend seems to be, which is just about getting into motion, sort of secondary sales, often driven by servicers and their underperformance benchmarks for the securitized portfolios that they're servicing, that need to raise liquidity or not raise liquidity, need to generate exits from the portfolio to meet the business plan, and the business plans have been often set quite aggressively. So these secondary trades are another sort of trend that we are seeing. Outside of Greece, each market has a little bit its own specificities. One interesting space which has been about to get going for quite some time, where the foreign currency denominated mortgages in Poland for example, which have been in a sort of legal holding pattern with a court decision every now and then, pointing a bit more to the north, a bit more to the south, and there is substantial stock that could be traded once the legal issues get clarified. And several of these themes in different countries, but I think these would be the main things we are seeing at this point.
Thank you. Bringing Alina in. Alina, what's your perspective from the Cyprus side?
Thank you, Richard. So as a general first comment or remark, I would say that from my point of view, NPLs will rise everywhere in the near future, but some countries, let's say, are more exposed than others. And when it comes to Cyprus, I think that at least three main factors should be considered when we look at the NPLs in the future. The first one would be related to the high levels of already existing NPLs in Cyprus. So even though, let's say, the stability of the banking sector in Cyprus has been has improved in the recent years, and with significant reductions in the NPLs during 2018 and 2019, the European Commission has noted that the country entered the coronavirus crisis with vulnerabilities mainly related to the high levels of NPLs in a context of a moderate potential growth. Talking about the second factor, or moving on to the second factor, it would be a matter of the sectoral composition of bank corporate loan books, because this matters when we are looking into the NPL development. And from this perspective, we need to understand that Cyprus is highly exposed to business sectors that were extremely affected by the pandemic. And the most relevant example in this respect is the tourism sector, which plummeted in 2020 with receipts falling approximately 85%. And the third factor that I would consider for the NPL outlook would be the high scale of SMEs in loan books, as these were hit, let's say, relatively harder than larger companies, and it will take them longer to recover. Another important aspect that I would like to mention here would be related to the, let's say, performing loans. Approximately 50% of the performing loans in Cyprus they benefited from a moratorium that was put in place. A first moratorium for payment, let's say debt payment, was put in place in 2020. And even if the early signs were, let's say, encouraging, it is still too early to say how new inflows of NPL will develop or they will look like in the future. But the most important factor that I would like to mention is that prolonged financial issues for companies for sure will affect their ability to repay. And from this point of view, I also see NPLs rising in Cyprus in the next months, let's say, or in the next year.
Thank you. Jim, let's just move across to your side of the Atlantic. How do you see it from your perspective in terms of distressed debt and distressed debt investing?
Sure. Well, I guess the scenario you alluded to in your sort of intro to this question hasn't come to pass here. The markets turned around pretty quickly early last year and have roared ahead. Combination. I mean, the turning point was really when the Federal Reserve stepped in a very big way, as well as the federal government, to provide liquidity and to support the economy. The lockdown started to ease early summer here last year, and then there was obviously the successful vaccine development and rollout. So the net of all that is that there was about, in March, there was about $1 trillion of distressed high yield and leveraged loans in the US. And that number now is down to 50 or 60 billion. So it's dropped by about 95%. There's really not much to do for distressed investors looking for the pure, good company, bad balance sheet type situation. There's been plenty of liquidity. Companies have been able to extend maturities, and there's liquidity both on the high yield market, the leveraged loan market, and there's a massive private credit market which also has a strong bid for paper, and that market is just almost as large as the other two markets, and is very liquid and very aggressive. So it's eased the stress for many companies, and frankly left us with fewer opportunities. A few segments lagged. I'd say energy was a laggard, but that has caught a bid over the last couple quarters. The sort of classic reopening trades, everything from cruise ships to hotels. Once the vaccines look promising, that opportunity pretty much dried up, and return to normal became fully discounted in the market. People always ask in our business, we always get the question, like, when will the cycle change? When are we going to see a lot more distressed opportunities? And the answer is, who knows, right? It's always something that the markets don't expect. Otherwise, the markets would be discounting it. But in general, it's going to be obviously some series of events that degrades the ability of borrowers to support their debt loads, and whether that's increased rates, tighter margins, the economy after this great burst in 2021 maybe settles back to a lower pace. It could be any of those things, or some other exogenous event that saps liquidity out of the market.
Thanks, Jim. John, do you have any thoughts that you'd like to share with us on this one?
I think it's becoming interesting. I'm actually interested to hear James' thoughts on this as well. There's not as much cash flow problems as we expected at the beginning, primarily because of all the government money that's gone in. But there are valuation issues now that are popping up, because you have a lot of businesses, say, especially in retail, restaurants, cruise ships, anywhere where they use comparable sales as a history of performance for EBITDA. And the banks loan, generally a bank will loan at a ratio to EBITDA. And now that EBITDA can be completely screwed up. So now you can have a lot of loans, I think, soon that will be out of covenant, which will be interesting to see how people deal with that, even if the company is not technically distressed. And it makes a lot of space for direct lending, where the commercial bank just can't make it work because they have certain parameters they have to fit within. So you now have some space for direct lenders to come in.
Well, there's a lot of businesses, particularly like we both brought up cruise ships, where they, there was a huge negative cash flow problem when they had to dock all the ships, and that was solved basically in the high yield market by borrowing first on a secured basis at healthy double-digit yields, and then continuing to borrow at lower and lower yields. Now they're borrowing unsecured basis, but they have ballooned their balance sheet to such an extent. You wonder. One, it's the equity recovery with all that debt behind it, but also what's the ultimate value of the debt now that the company's twice as levered as it was in 2019,
right?
And the business is coming back, but it's still not back.
No, it's also been a big issue with private equity. So they're holding a lot of companies that are still generating profit, but the valuations are dropped significantly. So now the PE is out of the money, at least technically. So where are they going to go with that?
So I'm going to move on, and unfortunately we're still waiting for Fotis. So just move the order around a little bit, guys. So the pandemic saw hitherto unprecedented stimulus and other measures introduced to protect the real economy. And moreover, while banks acted quickly to increase provisioning, recently some of these provisions are getting released. Are we seeing potentially sort of latent credit risk issues arising? I mean, unlike the GFC, the global financial crisis, the banking sector is, generally speaking, better capitalized, more resilient than it was then. But nevertheless, real world issues, if not tackled, could circle back and start to erode capital buffers. And I suppose the thing that sort of weighs on the mind is, to what extent have companies perhaps become reliant on some of these stimulus measures to keep going, and you get the risk around the sort of zombie companies? you know, should the focus be more on sort of weeding out those companies which can never recover, may already have been in some distress at the start of the pandemic, and focusing instead on those restructuring those which can survive? What are your thoughts on those? Perhaps starting with Alina.
Yes, thank you, Richard. So I will start by also saying that indeed governments have put together large-scale rescue packages in order to keep their economy keep their economies ongoing, and also at the same time, let's say regulatory measures have also been put in place in order to help banks not to mark as NPLs the loans. Yes, in the case of those holidays, payment holidays that were granted, together with also the securities or the government guarantees that were extended. In the meantime, though, the companies many businesses were suffering, the numbers of defaults have dropped significantly in many countries. And this is the paradox. I would also say that in recent months, bankruptcies have stabilized somewhere in between 15 and 30% below what was the normality before COVID-19. And for sure, this result shows that rescue packages, while, let's say, helping companies getting through the crisis, they also kept alive some zombie companies, indeed. And this is also the case for some non-viable small to medium companies. This is a very common case in Cyprus that are also family businesses, and in which case the owners have a tendency to support their businesses through personal lending, which is very wrong. So, but this being a circumstantial situation from my point of view, I think that many of these companies are going to enter different insolvency proceedings in early, let's say, 2022, if not in the following months. But another thing is important. In the meantime, we are facing a new reality, which calls for different types of measures, meaning, let's say, a comprehensive set of measures and policies to alleviate insolvency strains and also to prevent bankruptcies of companies that could become viable in the long run. And this should be our focus. So we need to take care of these companies, because as we know, a company can be financially distressed, but yet economically viable, that's worth being saved. And this is what the European Restructuring Directive aims to achieve by imposing to member states to create, to offer, let's say, a restructuring, preventive restructuring framework to all those companies that are currently in a situation of being financially distressed, where there is a likelihood of insolvency, in order to prevent insolvency from happening and to ensure the viability of these companies. Distressed companies should have or should be offered a second chance, the chance to restructure their debts under the protection of individual enforcement actions based on let's say, on the majorities of their creditors' decisions. Moreover, what the directive does for new financing, for example, or interim financing and other actions, business or restructuring related actions, it provides for these actions to be protected from avoidance actions, let's say, that could happen in the case where a restructuring fails and those companies need to apply for insolvency. What we all should keep in mind is that for these preventive restructuring proceedings to become effective, special care or attention should be paid to early signs of distress, and not only by the business owners, but also by their partners, because this will help us to put in place action plans that are viable in a timely manner, safeguarding all, let's say, safeguarding the interests of all parties involved. And last but not least, from my point of view, this is my special, let's say, this is my favorite argument, it's that preventive or prevention is a mindset. It's not about the proceedings, it's about the mindset. And this is something that we need to work on together, because from my experience, let's say, this is the first time in the history, let's say, from my point of view, that we need to work together. It's not about your goal or my goal, it's about the common goal, which is the greater good. So this is a process, and it entails, let's say, an unlearning. Let's say you need to be open to unlearn old business habit and to replace them with new ones. So it is going to be a process, but hopefully we will get there.
Thank you. That's really interesting. So that's the sort of restructuring professionals an insolvency professional's view. So, John, do you want to? What about your view as an investor? What's your view in terms of what should be the focus?
Actually, I find myself sort of agreeing with Alina. I think normally I would be more in favor of pure free market resolution of these issues, but in this case, we're dealing with an economic crisis that was to a large extent caused by government mandates, and they're justified for health reasons, but still this was sort of, in a sense, an artificial crisis created by government rules, and I think the government does have, in this case, a responsibility to at least provide some cushion, especially to the smaller companies that were affected by these rules, and not just let them get wiped out.
Thank you. I don't know whether Karel or Jim, if you've got any additional perspectives you'd like to think about on those. I should say at this point, and also to the audience, that there is a chat function which enables you to email your questions to Martin, and then Martin will pass them on to us. So please feel free to do that. Okay, let's move on with the agenda. I think unfortunately Fotis is still delayed. And Alina, I'm going to stick with you actually here, if that's okay.
Sure.
So we talked. You talked about the EU restructuring directive. Is there anything else that you think that regulators or policymakers should be focusing on at this point, in terms of helping companies get back on track, and perhaps what shouldn't they be doing?
Very good question. I would highlight that the focus nowadays should be on prevention rather than cure, and this is the principle, the main principle, which is reflected also by the actions that were proposed within the, if I'm not mistaken, by the European Commission's 2020 NPL Action Plan. The strategy therein was to provide a strengthened protection for both consumers and vulnerable borrowers. By implementing a set of measures, among others by fostering the development of secondary markets for distressed assets, by improving or reforming the insolvency and debt recovery frameworks at the European level, and also by promoting the establishment of these AMCs, the national asset management companies, and their cooperation. So from my point of view, I think that we have the solutions, they are all there. Now it's up to member states to implement them. And luckily enough, or fortunately, we have some of these measures, let's say, proposed. They come also with a deadline for implementation. And this is the case of the European Restructuring Directive, which should be transposed within the national legislations of all member states by the 17th of July 2021. However, member states were also granted the possibility to apply for an extension of this deadline with another year. And unfortunately, this time, I would say, some of the countries that applied for this extension do not have, at this point in time, and I'm stressing this, they do not have, let's say, the preventive restructuring tools in place in order to be able to foster and to properly take care of the situation in their countries, let's say. Also, Cyprus is in this particular situation. We have some procedures in place that are not properly used, where the restructuring is possible, but unfortunately the procedure is it's very formal, and because of this, it is not accessed by the interested or parties or by the debtors that need it. So what I would say it's of utmost importance right now is for member states to understand that there is no time for delay. We need to implement these measures as soon as possible. On a general note, or as a general note, and on a special note, I would say that this is not the time to delay the implementation or the transposition of the European Restructuring Directive, especially in those countries where NPLs or high levels of NPLs prevail, because such an approach will only, let's say, contribute to further increase in their vulnerabilities.
Excellent. And I'm delighted that Fotis has been able to join us now. I know he was in a meeting beforehand. So so glad that you could join us, Fotis. Thank you very much. I mean, do you have any specific perspectives on this particular one? I think, focusing on what the regulators have been doing and specific initiatives that you've been working on, perhaps?
Yes. Continuing what the previous speaker said, we as Greece have already harmonized the EU directive on insolvency, and it's been operational since 1st of June. It's easier said than done. It's one thing to harmonize the law and another thing to implement it. So now we have developed secondary legislation, electronic platforms, etc. And we are currently going through the pilot phase of first implementation. This will have a duration of approximately 3 months, and then maybe we need to do some improvements. But we've started already because it's very crucial, since gradually the support measures that the government is providing to businesses and households stemming from the EU financing are gradually phasing out. So debtors will need a tool, an effective tool to manage their debt, either towards the banking system, their loans, or towards the state. I mean, tax authorities, social security institutions. So as we've seen in the past, in previous crises, there is a, let's say, competition of creditors between them. So the debtor faces a simultaneous problem from various different creditors, and usually these creditors do not coordinate. And that's why all these automated systems are very important in order to facilitate this, let's say, holistic debt restructuring approach. Now, NPL are expected to rise. In Greece, this is expected something like 5 to 10 billion. So it's something like 5 to 10% of the legacy non-performing loans. So this is the expectation for the market. We've done considerable measures in order to minimize this. For example, loan moratoria, loan subsidies, especially targeting mortgages as well as business loans. However, all this will phase out by the end of the year. So beginning of the next year will be challenging for debtors, and they will try to utilize the available tools. We have upcoming actions, especially for investing. We will utilize, as all member countries in the EU, the Resilience and Recovery Facility. It's a huge package of 750 billion, 32 of which will go to Greece, and something similar to the neighboring and other countries, in order to promote investments and assist the economies to recover.
Thank you. And Fotis, perhaps staying with you on this one, I mean, with your, as I said, with your sort of like regulatory hat on or policy-making hat on, thinking about the last financial crisis, we saw the development of a number of different alternative tools to manage high levels of non-performing loans. NPL sales, securitizations, asset management companies. To what extent could these be helpful in this sort of post-COVID cleanup period? Or to what extent do you think they are likely to be less helpful? Starting perhaps with you, Fotis.
I think they will again be helpful, especially NPL sales. At the moment, we are preparing another APS scheme, which is extending the previous one. So the state is guaranteeing the senior notes of an NPL sale to provide the necessary guarantee for foreign investment. And I expect that this will happen again, and maybe we'll see it even more. Now, if the problem becomes even greater and combined with other problems, maybe we need some other systemic solutions. This has not been decided yet, but of course, we're on the lookout for any, let's say, tools that could be used in order to address the NPL issue. And let's not forget that whenever we discuss the NPL problem, a little bit behind it is the NPA problem. So at one point, because one crisis comes after the other, so we had 10 years of financial crisis, and then we had the COVID crisis. So compounding effect of the two, at one moment we have to start thinking about the values of these assets behind all these loans. So one crisis leads to the next, and I think it will be a challenging issue for the future.
Mm. And what about asset management companies? That's been sort of mooted in different different guises. National asset management companies, a pan-European asset management company. Do you have any thoughts on that?
We are currently trying to promote a kind of asset management company which will handle the certain assets belonging to the primary residence of vulnerable debtors. Usually these assets are of small value and of no or very little significant investor. And that is why the government is stepping up in cooperation with foreign investors to set up a company which will acquire all these assets and lease it back to them. It's a kind of sales and leaseback scheme. So it targets the assets instead of the loans. And that's why the debtor has to go through either a bankruptcy process or enforcement process. Of course, maybe this will be extended in the future, and maybe we will see a more broader AMC, including loans, but I think it's too soon to say. We're still in the discussions. I believe by the end of the year, we will have a clearer picture about how we proceed, not only in Greece, but all over Europe as well.
Thanks, Fotis. I don't know whether any of our other panelists have got anything to add on those. But I think if not, we'll move on to, I think, yeah, sort of like a rounding up question. You know, sort of on the minds of all investors in particular will be, you know, what are the sort of focus areas for distressed debt investing, you know, geographically and in terms of sectors over the next sort of 12 to 24 months. And you know, maybe we'll start, if you don't mind, John, start with you in terms of from an investor perspective. What are you sort of focusing on?
We're focusing at this moment more on direct debt rather than looking to buy loans, given sort of the we're sort of still in a transitory period. Valuations are in flux. I was talking about, I think that there's an opportunity now with commercial banks being somewhat hampered. I think it's a very interesting moment to try to go forward with direct lending. So we're looking more at those opportunities.
Okay. And any specific territories, do you think?
Primarily we stick to our home markets. So it's primarily Poland, Austria, maybe a little bit in Germany, Italy as well.
Okay. Jim, what are your thoughts?
Well, I mean, it's interesting, John mentioned the direct lending, because a lot of distressed investors have sort of pivoted to that here. More, you know, we call them rescue loans, basically coming in with an expensive loan that banks or existing creditors won't provide. But that market's still competitive here. There's quite a lot of people looking to do rescue loans. So you have to pick your spots, and you're putting out 100-cent dollars there, right? So you want to be sure that there's going to be a recovery. Our strategy is primarily opportunistic. I mean, it's hard to identify sectors or regions. We look more for specific situations where there's some problem, or maybe there's an issue with individual holders that force them to seek liquidity for their positions and try to get opportunities there. But there's always companies, wherever you are in the cycle, there's always companies going bankrupt and failing. But there's always opportunities to get involved in their debt, but those aren't always profitable opportunities. So you have to get in at the right price and the right time with the right business. You know, there's opportunities, or there's certainly distress here in commercial real estate, particularly areas focused on retail, office space. But the future there is different than the future was a few years ago. So there's a fundamental revaluation process that has to go on when you buy that debt. So that's the long answer. The short answer is that we're being very cautious right now. And to the extent there are, double-digit return opportunities, to make a broad statement, most of those involve more risk than the returns pay you for.
Okay, thanks, Jim. Karel, do you have any thoughts? What are you focusing on?
No, EOS is a relatively broadly positioned company, sort of covering a number of countries with teams on the ground. So I think we will continue in that strategy, sort of keeping our presence, in every single country where we have our operations, and similarly to James, combine that with opportunistic approach wherever an opportunity arises, sort of go after it. So it's sort of a mixture of this almost carpet approach to sort of the European jurisdictions, and if there's a deal, we do also, the more exotic countries like Serbia, Bulgaria, but we are, some of the largest markets that we're active in are France, Spain, and most recently also Greece. So I think we will continue in that. Sort of the specific segments that we feel are coming, obviously the hotel sector that we do believe will have a comeback, and we are seeing a lot of opportunities from owners or operators also in Greece who didn't set up their balance sheet properly and got into an issue in spite of sort of the government support. And we are also sort of tentatively exploring the direct lending, private credit markets as an alternative, in particular in those countries which don't really have the, if you want, traditional NPL deal flow, but we still have the teams and we do have the balance sheet in the European context, and we're sort of looking at smaller private lending transactions in distressed situations.
And Alina, perhaps from a restructuring perspective, what are your thoughts here?
It's difficult to say from a restructuring perspective, but let's say that I would try to use my former investor more or less perspective, and I would say that Cyprus is still an interesting market for this type of business, because for sure there are going to be portfolios that are going to enter the market at the beginning of 2022. There were portfolios that were sold also in 2020. And we had a major transaction going on in the first quarter of 2021 as well, Helix 2, for a value of approximately 2.2 billion euros. So I believe that Cyprus is still an interesting market from this point of view, but I would also maybe drop an idea that investors might be willing to reconsider the way they are assessing the portfolios or their business, or to change maybe the way they are doing business right now, because also investing in some, let's say, not NPLs, but companies that are viable, let's say, it might be a very good option moving forward. So maybe to assess the portfolio from a different point of view, not just going in, buy the portfolio and try to recover everything that can be recovered, but to invest in the companies within that portfolio. If the company are viable, if the companies for sure are viable, and this will take a due diligence before the sale. But anyhow, this is happening all the time. So I believe that maybe a change of perspective would also help.
Okay. I sort of sense that maybe is that something that you've been thinking around, Karel?
I think that's one of the directions we've been exploring, and I think over or across all the jurisdictions we've had, unfortunately, a couple of instances where we were able to do this. The principal issue tends to be that the borrowers that make it, maybe with the exception of Greece, which, because of the large volumes of NPL portfolios, there are also viable companies. But in the rest of Europe, once an NPL makes it into a portfolio, typically the type of borrowers are not restructuring cases. It's really 1 out of 1,000 that has the potential, and 999 are really liquidation play, and it's about the real estate valuation in an enforcement, the timing. What we are looking at is, we started with the idea to look in the NPL portfolios and seeing, is there someone with whom, if we structure the new loan properly, we could support them in recovering their business. Honestly, we didn't find many because of the nature of what goes into the portfolios. What we are looking at is more individual sort of single ticket deals with banks, which for some reason, sometimes it may be a legal complication, sometimes it may be sort of past track record with the borrower, where the bank is not able to provide fresh money to a distressed borrower. So in these situations, sometimes working with the banks and buying their, if you want, single exposure, and sometimes it's really borrowers coming to us with an idea, and we do have sort of lending licenses in a couple of jurisdictions, so there we can even sort of originate new loans and are doing it that way. Yeah.
Okay. I mean, Jim, what are your thoughts on this? Will you buy into distressed debt with a purpose of sort of turning it around? Is that part of your portfolio strategy?
Yeah, we're focused on restructuring and either turning it around or analyzing a situation better than other people and getting a recovery through a refinancing or some sort of takeout. We're generally not interested in liquidation plays. And there's certainly in the corporate market and the leverage market here, banks, to be honest, aren't really big players. They make loans and the loans are blown out in CLOs or loan funds, or they arrange high yield bonds and get their arrangement fees, and those trade on a pretty active, depending on the market. They trade. The distressed debt we buy typically hasn't reached the point where it's non-performing. I mean, it would still be paying interest, but there's a question for how much longer, or whether it can meet a maturity. Usually, by the time it's a full non-performing loan, it's probably too far gone to be of interest to us. And the banks and the holders are pretty quick to sell things that they think are going to be trouble down the road, particularly in the loan market, which is driven by CLOs. They're very ratings oriented. So if they see a ratings downgrade coming, they'll look to rebalance their portfolio and get rid of the ones that look to be downgrade candidates. And so, you can buy them at a discounted price, but they're still performing, and they may perform all the way until they hit the maturity that they can't refinance, and that's the point of the restructuring.
Thanks, Jim. I mean, maybe give the last word on this one to Fotis with your sort of regulatory hat in terms of, what your thoughts on Alina's comments in terms of support to viable companies, but which need a little bit of help in terms of turning around. Do you have any thoughts on that, Fotis? I think you're on mute.
Oh, okay. Sorry, the thoughts on what James said.
Well, both, and in terms of Alina's comment was, can there, if I can get this right, Alina, correct me if I'm wrong, perhaps more of the focus should be, or can we have some focus on support to companies which are viable but need some help in achieving that turnaround? I think that was right, wasn't it, Alina?
Yeah.
First, you have to distinguish which ones are viable and are not. and this is not, an easy task to do. Some companies, they face problems even before COVID due to the extensive financial crisis of the previous 10 years. And by the time they, started to, let's say, manage the situation, COVID occurred, and now they are again in the loop. So the first one is to see which ones are viable or not. And this is not an easy task. And that's why the new package from the EU of the Recovery and Resilience Facility has this concept of transformation. So companies need to transform. They need to become more digital. They need to become more environmental friendly. They need to become more energy efficient, etc., etc. So someone who is viable today may not be viable tomorrow. Of course, nobody knows what will happen tomorrow, but for the next 3 years, we have this EU huge package of financing that assist companies in transforming. So in my perspective, companies that come up with a business plan of transformation by utilizing the EU funds either are already viable or will become viable. So we need to assist them in any way possible. If they have debt, to restructure the debt, give them long-term solutions, etc., etc. Companies that are not taking the chance, the opportunity to utilize EU funds, and they do not want to transform, I'm sorry to say that, but it's like talking to a dinosaur. It would be very difficult to survive the pandemic after 10 years of financial crisis. And we could discuss about providing all the help we can. I'm doing it every day, but things will become even more difficult in the changing economy.
Thanks, Fotis. We are at time, unfortunately, ladies and gentlemen. I know that one of our panelists, John, you need to drop off, I'm afraid, but thank you very much.
Everybody, pleasure.
Thank you. Just going to ask Martin if we have any questions.
Richard, no questions came through, okay. But regardless, it was a really interesting discussion. So
yeah, I just want to say thank you then to the panelists for very engaging conversation over the last hour or so, which I found very, very stimulating, and I'm sure our audience will as well. So thank you to all of those, to all of you, and thank you, Martin. Over to you now, I think.
Oh, look, I'm just going to wrap up, but I did like the angle we took at the end, which leaned towards a, dare I say, an ESG type of focus, which is certainly something we're noticing becoming bit by bit more prominent in this sector. So we're keeping our eyes on that and maybe even have a panel on that next event. In any case, yes, as Richard said, thank you to all for joining today. Great discussion, very interesting, and special thanks to Richard for doing a great job moderating. So
thank you.
Wish everybody a nice afternoon, and Jim a nice morning and day ahead.
Yep. Thank you, everyone.
Thank you.
Thanks,
everyone.
Bye.
Bye.